And now we're moving on to our final lecture in this section, central banks, who are the liquidity controllers. So why do we need to care about these central banks? Well, because macro liquidity is the most important macro fundamental and central banks primarily control this liquidity, we really have to understand how a central bank operates and why it does what it does. Okay, we need to know what their goals are, what they want to do, and then how that affects macro liquidity. So this is what central banks typically want. They want low unemployment and moderate inflation. And they believe this combination is the optimum state of an economy. So being the very pompous and cocky economists that they are, they pull the strings behind the scenes with interest rates and other different types of more complex policy to get what they think is the best for the long run. Now, the efficacy of these programs can be debated, but this is what they're doing right now. So they target typically 2% inflation and 5% unemployment. And they do this by adjusting the interest rate, the benchmark rate. So all central banks in each of the respective countries adjust this rate. They usually go higher rates when we're in a boom and then lower rates when we're in a bust. And from this benchmark rate, all their rates are derived. So like I said, they control liquidity by moving these interest rates up or down. And when they move them up, money becomes more expensive to borrow. When they move them down, money is cheaper to borrow. And so the important central banks, the ones that really move the needle here with our markets, are these four. And the Federal Reserve is the central bank for the United States. The People's Bank of China is China's central bank. Bank of Japan is Japan's central bank. And the European Central Bank is the European Monetary Union Central Bank, which controls the cost of the euro. So another thing you'll hear about central bankers is this hawk versus dove concept. All right, you're going to hear it a lot in the media and financial literature when you really start reading about macro every day. And they always talk about whether the central bankers are going to be dovish or hawkish. So what a hawk is a hawk wants to tighten liquidity. They want higher interest rates and less stimulus. They want the market to cool off, the economy to cool off. A dove wants easy liquidity. They want to ease money and ease credit. Okay. And when they do this, it stimulates the economy and things tend to go up. So one thing you gotta understand, and this is a great picture of Leo from Wolf of Wall Street, is most central bankers are doves. And that's just because policy is so short term, and these people think in such the short term, they just want the market to go up while they're in office, while they're at the seat of the helm and they're in control, that they just like to print money and throw money at problems and keep interest rates very, very low and have the cost of money as cheap as possible. So that's it for section 4 here, the takeaways. Number 1, the transaction model is the best way to conceptualize the economy. And we talked about why that was superior to the conventional economic model. And that's simply because it's just more representative of what really goes on. There's way more credit than money in the economy. And that's why we need something like a transactions model to really look at what is going on under the hood. The availability of this credit or liquidity is the most important factor to financial markets. We saw Stan talk about that in his quote. And central bankers control this liquidity by raising or lowering the interest rates. Liquidity conditions are the absolute most important thing for financial assets and financial markets, and they are ultimately controlled by the central banks. And then most bankers keep rates low and are massive doves.